If I have a 7-page Sankey research note right now, and it's loaded with all that micro data you do, what's the one talking point you're telling Mizuho clients right now?
If you could give me a piece of information, it would be around sanctions or not. So that's where we just don't know, right? So at the moment, everyone's very excited about the gasoline market. Going into summer, there's issues. And we just don't know whether or not the gasoline price is going to get high enough for them not to do sanctions.
We just don't know, and yet the synthesis of Sankey Petroleum is you have a confidence in price. I heard this from your cohort in crime, Jeff Curry of Goldman, yesterday, too. You guys have a confidence in the market, and yet you just don't know. How do you do that?
Well, we've got a big friend in the Saudis as regards modeling the market. So Saudi's now producing below 10 million barrels a day. They've got their foot on the neck of the market, effectively, in terms of keeping it tight. But they are going to run through sanctions. They're not going to make the mistake they made in November.
Will it affect their fiscal policy? Is it so important that the royal family's fiscal plan is affected by this underproduction?
They're saying unprecedentedly, more or less, that they want 70 to 80 Brent. And historically, Saudi hasn't really set a number, but actually they're more comfortable generally with a 70 to 80 number. I think the risk for them, though, is that they lose control to the upside if we get these sanctions.
But, Gina, there seems to be quite a difference with what equities are doing when it comes to some of these commodity stocks and the actual commodity.
Yeah, it's really amazing. I'm glad you brought it up, Francine, because if you saw just the price action last year, you had phenomenal gains in energy prices in the first part of the year, followed by a crash. Stocks basically went nowhere. I mean, energy stocks just disbelieved the gains as well as the losses and sort of traded sideways relative to the market, down certainly when the broader commodity price complex was falling. It's somewhat similar this year, even though energy stocks have rallied back from their lows in December and led the gains up to this point in the market. That rally is not enough, considering the significant gains in oil prices. And then there's just this detachment. I think that energy investors in the equity market are just sitting in complete and utter disbelief that we're ever going to see persistent gains, durable gains, driven by demand in oil prices. And this is a situation that we've been in for several years. But frankly, what I think we've been trained as equity investors to look for is that key, that's demand. The supply-based movements in oil prices have not translated to energy equity gains, and they more than likely will not translate into energy equity gains over the long term. There's just a lot of volatility based on supply. And, eventually we will reach a low. But for now, energy just continues to contract as a share of market cap of the S&P 500. There's just this disbelief.
But, Gina, are chief executives of, some of these big oil majors investing enough, or is that why the price is going to go up? Because they're just kind of laying low in terms of investments for the future.
They are, but there was enough capital spending recovery last year to suggest that investment is still consistent. I mean, they're definitely restrained relative to where they were in, say, the 2011 to 2014 time period, where clearly investment was excessive, not durable for the long term. But there was enough improvement in capital spending last year to really scare off the equity investor. I do think also the other thing is, what are they doing with this cash? Buybacks were all the rage last year as well. What we found with those buybacks is the efficacy was very, very low. So investors are very frustrated with this.
Okay, well, let's go to Paul. I want to bring up the chart right now. This is a chart I've done for years. It's an approximation. Okay, don't memorize this. Paul Sankey doesn't have this as a tattoo on his left arm. It's oil adjusted for inflation and then adjusted for rising incomes in the United States. And the bottom line is, Paul, adjusted for all this, oil's back to where it was in 1970, the yellow arrow. Okay, explain why I need to invest in oil if it's been a gross commodity deflation for years.
Well, I think that's the problem, is that obviously the market wants to buy tech, and tech is going to affect demand for oil and supply for oil. So there's an obvious secular issue with lower prices in the future.
But state the case for bigger intermediate production oil investment. Should we buy a given stock here or there?
Yeah, because the fact is that the tech effect is overstated, particularly on the demand side. So we're still seeing 1.5 million barrels a day of annual demand growth. I don't see the tech coming through in the demand numbers. We don't have the efficiency that the market's discounting. And by the same token, I had lunch with a senior Gulf source yesterday, but I was also just out of the Exxon and Chevron analyst meeting. They firmly believe there's underinvestment as referenced in lower capex. So there's a serious likelihood that prices go a lot higher based on technology not delivering as much as the market's discounting.
This is incredibly important. The arch Paul Sankey call, to Gina's point, is dividend and cash flow to support total return.
If tech's going to get you eventually, which it will, obviously, it must. I mean, we always say that the 20th century was driven by oil, the 21st will be driven by electricity, ultimately. But the reality is, over the next 20 years, this effect is overstated. The effect, what the companies have to do is return cash to pay people for the risk of owning the stocks in a twilight age. It becomes like tobacco stocks in an extreme version.
So, Paul, are you telling me that we've been promised too much renewable energy, right? Do we need to adjust our timelines of expectations?
Yeah, exactly. So it's all about tenor. This is why the best performing sector last year in oil was refining. Now, why would you possibly buy a refiner at the end of the oil age? The answer is because they can return so much cash to shareholders. And so the solution, as we've said to these companies many times, and it's still controversial with E&Ps, is to pay people a very good return for owning your stock, so that over the next 10 years, you make the next 20 years irrelevant. If you can get to a 10+% annual cash return, which is, I think, within the capability of many of these companies, you don't care what happens in 2029, because ultimately you'll be playing with, you're owning an option on the future of oil, which may still have a great future. The other thing I say to people is you forget that oil is essentially liquid solar power in highly energy-dense form that's very easy to produce at low cost. It has a terrible public relations image amongst people, but the fact is it's liquid. So it's a naturally occurring, environmentally friendly when treated right, substance, hydrocarbon. And it just has a big public image issue with regards to it being spilt. But the reality of its energy density and the fact that it's liquid solar power
Let's come back. Paul Sankey with us.